Hello, everyone, and welcome to our conversation with Rashaad Tayob. He's the investment manager of our Nedgroup's investment income fund. And over the next 20 to 30 minutes, we're going to spend some time discussing South African fixed income markets, the performance of this individual fund, and then maybe turn our attention to where some opportunities are emerging in the market. Welcome, Rashaad, and thank you again for joining us today.
Hi, Doug. Thank you.
Rashaad, I imagine the past few weeks and the last few days you've witnessed quite exceptional moves almost across every asset class. We've seen records being broken in US Treasuries, and we've seen volatility indexes rise to levels that we haven't seen before. I believe even gold was down 2 days ago, as investors just seem to be rushing for cash, and in that sense, particularly US dollars. And South Africa or emerging markets haven't been immune to this. And so, how have South African fixed income markets been performing in this environment?
Yeah, as you said, there has been a liquidity crunch going on in the global markets, and effectively, unless you were in US dollar cash, you have had to accept some form of losses or drawdown. The South African fixed income market, the moves that we've seen are quite extreme. If you look at the move in the bond market on the 10-year, it's moved up around just over 300 basis points. So 3% move in yields, and that has meant a capital loss on domestic bonds that we've actually never seen in the market. The only comparable is the 98 if Asian crisis, where bond yields sold off quite dramatically, but even there, yields were at a much higher level, so the capital level was not as extreme. In percentage terms, this is the biggest move that we've seen as far as the data goes back. In fact, when we thought in the Nenegate crisis, yields moved up 180 to 200 basis points, that was a very painful and quite an extreme shock. But this move actually makes Nenegate look like a bit of a mild episode. So we have seen severe dislocations in the market on both the domestic side as well as international bonds, where yields on emerging market debt on any type of credit name have spiked 5-10 percentage points. These are unprecedented type of levels, and the fund unfortunately has been impacted by.
Yeah, Rashad, you touched on how the South African bond market has performed over recent months, and there has been quite a dramatic spike in the yield. Can you maybe talk us through how the fund was positioned leading into these events, and particularly some of the drivers of performance within the fund over the last week?
Yeah, so the fund has had a drawdown of about 3.5% in the last on a month-to-date basis, and that obviously is extreme move compared to the fund's history, where its previous biggest drawdown was under 8%. The drivers of that are effectively the bond market, where we had positioned with a 10% allocation to SA bonds. We felt that yields were above fair value, but we knew that there was some downside risks. And to offset that, we had some FX exposure, against that bond position in order to provide some sort of offset. Unfortunately, the move in yields has meant that the bonds have detracted by 1.5% in terms of an allocation. So even a conservative level of bond allocation of 10%, which we felt has meant that we've taken quite a bit of pain. So that's the one component. The FX has provided some sort of an offset by about 40 to 50 basis points, but the moves have been so extreme that it hasn't provided the offset it had historically been able to. On the local FRN side, that's been a slight detractor, but we were positioned in high quality liquid assets. Over the last 2 years, we bought a lot of senior bank debt. So on that component, we've actually been all right. On the inflation link component, slightly down but we've had shorter duration type positions. So moves have not been that significant, and in fact, shorter-term linkers have done pretty well in this environment.
We've also had quite an underweight in property, Rashaad.
Yeah. So just on the property side, we felt that a 2% allocation, the yield was reasonably attractive by historical standards, 12, 13% yields. But we knew that there were headwinds in terms of the local economy, in terms of the underlying, yield, the underlying income distributions on the property. But given how much it had fallen, we felt that some allocation was worthwhile. However, on a month-to-date, property has effectively fallen between 40 to 50%. So even with our low allocation, the effect on the fund has been quite extreme and is effectively cost us, around 80 basis points, just on a month-to-date basis. So that's, has been another detractor. On the international side, international bonds have been about an 8% exposure. We've also said we were cautiously positioned. We reduced our average duration down to just 1 year. So we thought we were, preparing for, because spreads were relatively had been low, across the board. We've reduced term, we've reduced that allocation, but the moves and dislocations you're seeing in the international bond markets are so extreme that even with a 1 year duration and 8% allocation, it's been a drag of about 60 basis points. So whereas previously we thought we were getting, we are getting 4 or 5% on our dollars with a reasonably good level of quality, that yield is now up to 10% in dollars. So that even though it's a short duration, the moves have been quite extreme, and this portfolio is now positioned to get 10% in dollars with just a 1 year duration on good quality assets. But that in the shorter term has been a drawdown. And then the final one is convertible bonds, where we had about a 1.8% allocation. And there the moves, given the falls in the equity market and the moves in the international bond market, that's fallen about 30%. So there's been a 50 basis point odd impact there. And now you're getting about a 10% yield on the convertible bond component, but unfortunately your upside participation has fallen away, and that's why you're seeing capital loss. So overall, the biggest detractor has been the local bonds, but there have been detractors from international bonds, convertible bonds, and property. And going into this, we felt that we weren't aggressively positioned. We had hedges in place in terms of the FX, but the scale of the move has been such that there hasn't been anywhere to hide at this point in time. The positive is that the yield on the fund has reset, and going forward, we believe that much of the portfolio is positioned to deliver quite attractive returns going forward.
Portfolio, and I think another really interesting point to touch on is the credit quality and how this impacts the expected return on the portfolio.
Yes, Doug. I think we've mentioned over the last year or two that the credit market in South Africa has been extremely well bid. So spreads had come down, and we've had a bias for senior bank floating rate debt. We avoided any form of bank sub debt, which we felt was way overpriced and had entailed quite substantial risks given the write down language in sub debt, and we thought there was downside risks if the banks came under severe pressure like what we are seeing at the moment. So from a floating rate or a credit perspective, we had moved to a more conservative positioning, quality names, average term, below 2 years. So overall, we think from that component, we are well positioned with a low level of downside risk from a credit perspective. And then from an overall asset class perspective, even though we've taken some pain on the various asset classes, the forward potential returns, I think everyone knows that yield and price are inversely related in the fixed income space. So as the price falls, the yield goes up. So for example, on South African government bonds, we still have that 10% allocation. We're happy to keep it especially with now that you've got the SARB cut the repo rate last week from 6.25 to 5.25. So there's a massive spread between money market or cash rates and then government bonds. So while the government bonds have caused us pain, the forward yield is now sitting at around 12.20. So that is in an environment with inflation sub 5, that is an attractive return going forward. I mentioned the international bonds. There, our yield was about 4 or 5% in dollars. Now it's 10% in dollars. If you hedge that back into rands, you're looking at a yield of around 15 or 16% with just a 1-year duration. That is a phenomenal return, in this environment. And that's an area which we'd be looking to add to, and we do have scope and capacity to add to in this risk-off environment. On the inflation-linked bond side, we have been protected in terms of our short duration, and you're now seeing real yields in the 5-year space over 5%, and in the 10-year space 6%. These yields, real yields, you have not seen, effectively since inflation-linked bonds were launched in the early 2000s. So the market pricing, and that's an area where we have capacity and we are able to allocate to. So the market pricing is now extremely attractive, and we're actually sitting with about 22% cash. So we were conservatively positioned from that perspective, and we have the capacity to really go in and buy these assets at much cheaper level of valuation. So linkers are something we're targeting. If inflation is 5, you get a 6% real. That's 11%. Plus, you have the potential you have that inflation hedge when you're buying inflation-linked bonds. So the potential downside risk is hedged out in that. So it's an asset we're confident in. We finding value in international bonds. We're finding value in inflation linkers, and we are seeing the offers come through in the credit space as this credit crunch takes hold. We're seeing forced sellers. We haven't bought anything in the last week, but the same as how post-Able in 2013, 2014, we were able to pick up high-quality assets, and where they previously were at 150 and 1.5% spreads, we were able to buy them at 4 and 5% spreads. So we stand ready to take advantages of these dislocations in the market at the moment.
Absolutely, and I think that's it. Just running through some of the yields that we are seeing in the portfolio, it does look really attractive, especially when you are looking at the quality that's on offer in the market. Rashaad, thank you very much for taking time away from the screen to facilitate this call, and I trust everyone on this call has found this conversation useful. Thanks again to those on the call for your continued support to the fund, and please note that we've recently produced a number of notes highlighting the performance of the fund. And if you do have any further questions, please feel free to contact your sales consultant. Thank you very much.